record. Hello, everybody. I see we've got some very courageous participants still with us on day 8. You guys are fantastic. Actually, I forgot. I hate doing this, but I'm going to mute everybody for now, and then I will unmute at the end, just so there's no distractions. Okay, so today is today's day 8. Can you believe it? We've got 2 more days. Tomorrow we start actually looking at the marketing funnel and being able to qualify and quantify some of our sales goals. But today we need to map out those sales goals specifically. So let me take you through today's exercise called Mapping Your Sales. The first thing that you're going to want to look at is you're going to want to look at your calculator that we did yesterday. Everybody remembers this little exercise that we went through yesterday, and if that isn't big enough for you, I should do it. Okay, so you're going to want to pull up this calculator and make sure it's the right size. And did I completely lose my... Where did my work go? Okay, this is not helpful. Sorry, I'm trying to find where, there we go. Geez, Louise. Okay, so here we are. If this happens to you, I feel for you. Okay, so you're going to want to pull up your calculator, and with your calculator, as you recall, we came up with some new sales goals here with respect to making sure that you break profit. Now, there's a couple things that I want to walk you through carefully, and I want you to know that as we start converting everything over, there's going to be a few glitches for you, and I'm going to explain why those things are happening and the process that I use to go through when I'm working with clients one-on-one. That is the disadvantage of this online challenge, but knowing that you've made it this far, I know you'll be able to work this piece out. So this is not going to be an issue for you. So now we have these new sales goals, right? In this case, we have our new targets that we are looking to achieve for each one of these product streams specifically. So your first step today is, and this might be an easy step for you, depending on where you're at with your existing sales process. But the first step is what I call understanding what's currently committed. So the higher the value of your product or service, right, the more you probably have some of these sales already committed for. So what I mean by this is, if this is what our sales goals are for, let's say that our time period is May to the end of April of 2020. So again, you've got to check that time period, whatever you're using in your cash flow. If you already have some of these projects that are committed for, that is what I want you to account for right now in step 1. So step 1, I'm not going to use it. Well, maybe we could use it as an example. I'll do that a little bit later. But I know in this specific example that I was working with with this customer, their custom homes, they already had 2 projects that were pending. The RFPs, the proposals had gone out, and so we banked on one of those projects coming in. So we knew that that was kind of taken care of. With some of these renovations, they might have had 1 or 2 large renovations that were already committed for. So once we took a look at those projects and understood the value of those projects, that came off of this number. So let me just repeat. Step 1 is you have your new sales number. I want you to go through line by line what projects, if any, what products, if any, what services, if any, are already committed for, because you are going to subtract that number, the sales volume, the sales, the amount of that sales contract, you're going to subtract that from your target because you've already made that. Does that make sense? I hope so. Okay. So now let's hypothetically say, this is where I need you to really pay attention here, because all of the work that we have done for the first time for many of you, this is the first time that you've actually set a cost of goods, and you see that as a very specific number and percentage, right? It's probably the first time that you might have adjusted your price a little bit. So you've got very new data from which to work from. The sales that you have already committed to in the past, all of those margins might be off a little bit. So here's what I want you to do. As an example, I'm going to walk you through this so you can see. I'm going to get you then to go back to your forecasting for profit tab. And I apologize that this is confusing or might be confusing. But here's what you're going to do. You are going to, there's a couple reasons why we're doing this, but we are going to add a sales item here called committed sales. I just want you to add committed sales, and we're going to add it as a brand new item. And why we're adding it as a brand new item is because I am 99.9% certain that this committed sale does not fall into this price point, especially if you're a product or service. And it is probably not, you did not put that proposal together based on, in this case, an 85% cost of goods, right? This was their former proposal where they actually knew that they might need to eat this. So at this point, they were looking just to break even on it, really, with the homes that they had out there, because they realized what they had done wrong in the past. They were actually paying an extra $10,000 for every home they were building. So what I'm going to get you to do, if you have sales, is I'm going to get you to do a line item called committed sales. And as an example, let's say in this case, this client knew that their home that they were going to build, the total value in was going to be $629,000. Let's just hypothetically say that. And this is the next important piece. When is the revenue going to be received? So hang with me, because I know a lot of you are going to ask, well, what about deposits and progress-based billing and works in progress? I'm going to speak to that in a minute. But let's just hypothetically say this home, the money, the payment in full is going to be made in March of next year, as an example. So what I want you to do, this is very different from what you're going to do in the next step. I am going to get you to put in the dollar value here just under committed sales, 629,000. See that? $629,000 is what I put into March. What it is doing is it is now saying $629,000 for the total project times $1 is bringing in revenues of 629. This is going to be very contrary to what I'm about to show you. This is why I'm speaking slowly, making sure that you get this. You are only going to do it for committed sales. You are then going to have to do a manual calculation on what your cost of goods are. And you should have that because you've already put together the estimate. So in this case, as I mentioned, they might be able to make a couple of adjustments here, but under committed sales, in that same month, I'm going to put it here. I'm going to say out of that 629, I'm going to say approximately 615, maybe even 620, because these guys were losing money on these homes. And the proposals had already gone out, so they had to honor that commitment, right? They were crossing their fingers they didn't get it. So we were banking on one here. And so you can see that in that project now they're making 9,000. They might actually maybe just even be safe. We would say in that specific one, because we knew that they were so off, we just say it's a break even. So this is where in committed sales, you are going to have to do the manual math, because they are probably not going to fall into the price structure that you've built here, nor will it fall into your cost of goods. So that's that piece. That's what we're going to do with committed sales. Simple as that. Now, the only pieces again that you are going to touch really up here is going to be your pale yellow area. And now with committed sales under cost of goods, you're going to have to manually put that number in to the sale, into that cell, but only for that row. That's it, just for committed sales. Okay, I will unmute after if you have any questions on that. So that is the first piece that you do. That is step number one, and I wanted to make sure that that was very clear for everybody. So now let's go back to this example, and let's say that hypothetically, this is a startup now, and none of this revenue is committed for. But if it is committed for, right now, maybe instead of custom homes, we have no work to do there potentially, and under renovations extra large, they might have had to. So however this is working for you, you now have a number, right? You take your target number minus your committed sales. You have a new goal that you have to achieve that year. So that's what you have to go out and market for. So with that number, what you are going to do, I'm going to pretend, let's say it's these numbers again, just for the sake of ease at this point, because numbers are confusing enough. All you are going to do is divide the target by the selling price, the average selling price, to get you how many units need to be sold. So for example, you can go back, you can write down these numbers, whatever it is you need to do. We know that renovations, medium renovations, are on average per project $100,000. Renovations large, $150,000. Renovations extra large, $250,000. And our custom homes, we said $500,000. You are going to go back here and again, write it down, whatever you need to do. And so we take $328,199 divided by $100,000 for the total value, sales value of that specific project on average gives us, you can probably do the math, 3.28, right? Your renovations extra large divided by the selling price of that project on average, 150,000, puts us at 5.5 projects required. Renovations extra large, $1,640,996 divided by, on average, $250,000 a project gives us 6.56. You can see how all of that math adds up. So in this case, I'm going to encourage you to round up, because here's another little piece that you're going to have to finesse as you move over here into cash flows. So once again, I go back to forecasting for profit. You can see that the majority of your lifting, all of your work this week and last week, is in this tab. So here's what I've done. I have rounded up, as I said I was going to do. So projects under medium, I've got 4 projects, and I've just put them in this case right now in September. I'm going to come to that in a minute, because I just want to make sure all of my math is going to add up. And here's a spoiler alert, it's not going to add up for you when you first do this, and I'm going to explain why. So you don't need to panic. Your numbers are off, and it's not a formula error. It is because we did something intentionally yesterday that impacts the numbers today. So if I say 4 projects for medium, 6 for large, 7 for extra large, and 1 house, I'm going to take this number out so that you know what I did back there. That's all clear. I just want to clarify this for you and keep it simple right now with respect to the numbers, so you can see what's going to happen in yours. These are the numbers. If we followed that plan for profit and we did these numbers, right, we've got our revenue, we've rounded up, so we actually get a little bit more revenue than what was in this plan, right? 3.2 is what we look for here. Now that we've rounded up, we're actually at 3.5, right? So you're like, okay, that's all going according to plan. Now, what is going to throw you off is your cost of goods. That is what is going on here. And I'm actually just going to take that out too. So what is happening here is that here we've got all of our cost of goods. These numbers are a little bit higher in this case than our plan yesterday, because again, we've upped the volume. Instead of 3.3, we did 4. Instead of 6.5, we did 7, right? But what is happening, do you recall yesterday, when you look at this, you can see that our percentage of our cost of goods is actually coming out to 80.71%. Yesterday, when we did the planning for profit, we came up at 77.5. And I know you're wondering, well, why is it different? And why could we not have planned for that yesterday? We could have, but it would have taken you 6 times the work. In this case, 4 times the work, because we would have had to do it separately. Actually, it would have been an extra 7 steps. So to simplify, what we did is we took these numbers and we took an average. And that's what got us our 77.5. Now that we understand the breakdown of our revenue streams and those costs of goods, this number has actually changed, right? And it's going to change, 99.9% certain is going to change in your case. So now it's saying that when you put all of these combined, again, because heavily weighted in certain areas and lightly weighted in others, right? Our cost of goods as a combined effort is 80.71. Your cost of goods per product and service still stay exactly the same. So I don't so much care for what is happening here right now. As you know, what I am most concerned about for you, for my clients, is the bottom line profit. So we had planned for 10%, but because we missed that 70, I forget what the number was, those percents came off of our profit, right? That's what happened. So it's okay, because we're still in planning for profit mode. We're still doing this, right? So now we know we need to make some adjustments, because right now we're sitting at 7.56% net profit, and that won't do. We need at least 10. So now I want you to come back up here, and this is where you get to decide, okay, so I need to add some extra profit to this situation. Where am I going to do it? 7 projects. We know that we make the most amount of money for the least amount of effort in our renovations extra large. So 7 in this particular example, this was actually a low number for them to even start with, and they knew they could do up to 15. And I said, well, let's set you up for success. So let's just say, let's see what happens. This is where you have to play. If you do 10 projects, and you can go across the board and see what dials in. So you'll see your cost of sales here, right? Your cost of sales is still pretty similar. We're still looking at 80%. All of your operating expenses have stayed the same so far. And now what happens to the bottom line? 9.76%. They were okay with that. I think I'd prefer to see that up a little bit. So what happens with 12? If we have a goal of 12, now we're at 10.84. So I always tend to push the envelope a little bit. It gets me in trouble. So let's leave that with 11 projects in renovations. Where are we at? 10.33. Everyone's happy. They know they can do 15. I've come down a little bit, and instead of the 12, I've put 11 here. Now we're set up for success. So I hope that that piece makes sense for you. So before you start mapping everything, I need you to just play with these numbers. So again, these numbers are the number of units, whether it's a product or whether it's a service or a project, that you anticipate selling. It's the number of units. It is taking that number, multiplying it by the price, and then giving you this sales volume with respect to dollars. That is what is happening here. That number times price equals sales volume. I hope that makes sense. Hopefully that makes sense for everybody. So now we've got that figured out. Now we actually know truly the number of units that we need to go after, right, to make sure that our profit hits. Now, I have to tell you, for some companies, you won't need to adjust it that much. I think it really depends on your cost of goods and the variance that you have for each product and service. And usually in my experience, if you are selling many smaller products, you might not need to adjust it at all. If you have big volume-based, if you have big valuable-based projects, you probably will need to do some adjusting here. So just to let you know that that is what is happening when we have to chart out how many units you anticipate selling. Okay, the next step is step 4, and this is where we start mapping out when you expect to receive the revenue. So I'm going to right now do a quick calculation to figure out what I'm going to cover right now and how much I want to give you and how much we're going to leave for tomorrow. Regardless, here's what I know for sure, is that each one of you and each one of your products and services has a seasonality to it, right? So you might have some complementary products where some sell really well in the spring. If you are a retail business, your outdoor furniture, right? If that's the business that you're in, your outdoor furniture probably sells really well in spring and summer. Your Christmas decor might sell really well, obviously, in the winter months, November, December. A lot of your gifts will happen in December. There might be some gifts depending on what kind of retail establishment you are. There might be Valentine's gift, birthday gifts, graduation. I don't know. Everyone's got seasonality to what it is that they're selling. So you're going to find that with projects specifically, right, you want to recognize the cycle that your clients are going to use to subscribe to a project or to buy a project. You know, obviously in renovations and house starts, heavily weighted in the spring, right? Actually, smaller renovations, medium renovations, a lot happens for them too towards the end of the year, October, November, December, because people are getting their houses ready for family and for holidays. So only you, I can't help you with this today, only you know when your product or service is likely to sell. So that's the first thing you need to figure out. When is this likely to sell? The second thing I need you to figure out is when are you going to receive the revenue? This is another very important reason why we do a cash flow. And we can get into minutia. I want to keep this very high level for now, and then I can show you how we're going to drill down. So for those of you that are service-based and have progress-based billing, you're going to have to hold on for a second because I'm going to speak to that after. What I want you to do right now, even if you're service-based and project-based billing, I want you to understand when is that project going to be complete so all the revenue will be in. That's the first place that we're going to start. And I'm going to show you how you can add layers of complexity on afterwards. But let's just budget for knowing that that money is going to, all of that money will be received by the end of that project coming due or the completion of that project. Now, a couple of pieces on that. I actually just worked with a client yesterday that 75% of their clients, and if you're in oil and gas, I'm going to tell you this is a doozer, right? Because oil and gas notoriously, the bigger companies don't pay for 120 days. So if you're showing that you're getting money in January and you're not going to be paid until January, February, March, April, right? You're going to be cash flow poor for a long time. So let's just show that revenue coming in April. So that's point number one around when you're going to receive the revenue. Point number two is when is that customer actually going to pay? So sorry, point number one is seasonality. Point number two is when is that customer going to pay? Point number three is that you can have terms around when the customer is going to pay. So example, oil and gas, you might say due upon delivery and they don't pay for 120 days. But the other piece is that even if you know that they are going to be paying in 120 days, I want you to start finding ways to make sure that that money comes in. So you mitigate your risk. Because again, this customer that I worked with yesterday, a lot of oil and gas, so they were getting paid late. And even after they were getting paid late, there were customers that weren't paying at all. So now what happens when you have customers that don't pay at all? Your cost of sales go up because the labor that you have to invest to chase that money goes up. See how all of that happens? So if you haven't even budgeted for that, then you're definitely out of pocket and it's coming off of your profit. So think about that piece. The other piece I want you to think about is that sometimes, not in every case, but in some cases, there's ways to mitigate your losses by explaining to the customer up front that in the event of failure to pay, services get stopped, right? So there's just an abrupt halt to services. The client I was speaking to yesterday is very uncomfortable with that, but they found a workaround where at the beginning of the contract now, they actually just say that the software is being programmed that in the event of 21 days past that billing cycle, if the money has not been received, that the system shuts down. It's not someone saying, I suspend services. So because that can compromise relationships. So if you've got any workarounds to make sure that you're going to get that money in when you've charted it, definitely do that. Another potential workaround for you is that you take a backup credit card, right? You take a backup credit card, and then in the event that payments are not made, that credit card gets charged. Another note on this is on your invoices, definitely talk about the interest that you will charge in the event that the customer or client does not pay. And I know many of you are possibly very uncomfortable with that. I know I've had clients with that were uncomfortable with it in the past, but here's the thing. You can charge the interest, and then if somebody calls you and pushes back on it, and most people unfortunately won't push back. This is what's happening in our society today, right? A lot of people have credit card debt and don't even know what interest they're paying. They might not even see, your client might not even see the accumulated interest charges, which really does not help you because you need to get paid. But why you put that there is because now you've got some negotiating power, right? So they call and they say, oh, you're charging me interest. You go, you know what? I would love to remove the interest charges, but let's negotiate a payment schedule. So when will this payment get paid? Okay, in 7 days, perfect, right? Once it gets paid, we'll remove the charges, absolutely. But in the event that it's not paid, as per this new agreement that we have in 7 days, it has to go back on plus the added amount for that period in which you took it off. So it just gives you negotiating power. That's all it does. And then you have to stick by it because you are setting the standard for how your clients will treat you. So if you're making it okay for them not to pay you, then they'll continue to do that. So, sorry, that was a whole thing on getting paid, but receiving revenues is so, so important. So I'm going to mention this before I forget. So those of you that are project-based and have works in progress or deposits, this is where we can build a layer of complexity into your model. But again, I don't want you to do it until you're super comfortable with all your numbers adding up as they already are, and you're comfortable knowing how to enter in these lines and making sure all your formulas are going to add up. So for example, let's say under custom homes, well, let's say under custom homes that we've got, this is a work in progress, right? A work in progress, or it's milestones and payments based on those milestones. So what you can do here, as an example, I am going to add a line item. So I'm going to insert, right? And I'm probably just going to insert, depending on how many phases you have, insert 1, 2, and 3. Let's just, whatever this looks like for you. So if I do custom homes, I'm going to do now custom home deposit, and then custom home, I'm going to just say phase 2, I'm abbreviating here, and then custom home final, right? So again, you're going to do the same thing here. You're going to insert, see what I mean? This is definitely a rabbit hole. And then if you do this, let me know, and we'll go through and make sure all of your formulas are right. But then this becomes a custom home deposit. All my spelling is off. Phase 2, phase 3. You can see what I'm doing here. And now this custom home number changes, right? Because there's nothing there, but maybe now in the deposit, maybe it's, I don't know, I don't, 150, I'm totally guessing. And then here we have another 100,000, and then, sorry, 100,000. Oh, good Lordy. 100,000, and now we collect our balance of 250, right? So if that is what you do with respect to your projects, you can account for it that way. You're going to want to copy the formula down here to make sure that everything is, this formula is easy. Your cost of goods is going to be a little bit more challenging because you will have to calculate your cost of goods for each one of these. So again, see what I mean about the minutia? This is where it works to work one-on-one, and unfortunately we don't have that right now. So if you're doing this put this in, let me double check your formulas so that you're good to go. Okay, so now outside of that, this is where you would take these numbers, right? And now you have to chart them. So in this case, for example, let's say that we know that they're going to probably have probably 2 small projects here and 2 small projects here, because in this industry, most of their small projects are those little pieces to help for the holidays. Here we have 6. So I'm going to just, again, this is me roughing it. This is you having to do this, putting a little bit more diligence into this process. So let's say 2 there, 2 in March, and 2 in April. This is when you get to chart when this is happening. And now we've got 11. So let's weight our 11 here. We've got, I'm going to say 3, 3, 3, 6, 9, and 2. And then our custom home, let's just leave it at 1 at the end of the year. We have to go back and change these numbers, right? Otherwise, so there we go, 4, 6, 11, 1. We end up with our revenues, and our revenues, because I inserted all of these numbers here, everything is off kilter. This is why we don't mess with the template on a live demo. So there you go. That is what is happening here. This is all you need to focus on today. This is the big piece. I want you to be able to determine exactly how many units need to be sold so that you're still making a profit at the end of the year. 10.43, we made a little bit more money because I took in a deposit for a house. Live TV here. And then I want you to map it out. If, again, today I don't encourage you to get into all of the extras, right? Like just get this base done. And then maybe tomorrow, once you've got this, then add those layers of complexity. But let's, for today, just keep it really simple so that you can wrap your head around this piece. And then once you're comfortable with it, we can start to drill down. So that's my bad. I shouldn't have shown you that, and I did, and I'm regretting it now. So forget everything I said. We'll figure that out later, how you can drill down. And again, you know where to reach me if there's any questions on that. Okay, that is it. That's it for our exercise today. That's what we call mapping your sales. Again, you're going to want to make sure that step 1 is understanding, are there any current commitments that you have? Any sales that you've already done, pre-sales, letters of intent, that you can take off what that goal is. You divide your sales target by your purchase price to define the number of units for each one. You're going to want to come back over here and make sure that all of your math is still adding up and you still have at least a 10% net profit. If not, I need you to adjust the volume of units that you anticipate selling, and then you are going to recognize the seasonality of your product and service, when revenues will be recognized, and then just on your to-do list, make sure that you're looking at charging interest, ways to mitigate that risk of people not paying, and those were the 2 big ones, right? Okay, now I see a chat. Is it worth using a factoring company? You know what, in many cases, if you can, so factoring is really just, it's a process in which somebody is going to buy your accounts receivable, right? So they buy it, they take off a couple of points, but then you get all of your money up front. So if you've accounted for that expense in your cost of sales, absolutely. Especially with oil and gas, it's done quite regularly, right? Because 120 days of not getting paid. But just, yeah, make sure that you understand the terms. It's certainly not a bad idea as long as you have accounted for the additional expense up front. Because if you haven't, you are going to be taking that money off of your net profit, right? And we don't want to do that. We want to make sure that you remain strong there. So you never compromise on that. All right, I am going to unmute everybody. And I always get stuck because it's always the days that I think it's going to be an easy chat. I'm like, oh, I've got this. How do you, mapping revenues is so easy. And then I get to it late and I'm like, oh my gosh, this is definitely more complex than I originally thought. All right, so there you go. There you have it. Everyone's unmuted. Are there any questions? You might need to turn on your own microphones.
I don't have a question, just a comment about charging these big oil companies interest. It ain't gonna happen. They don't pay it.
They might
I've
not
worked-
pay it, but at least you're letting them know that it's on there and that it does not go by unnoticed that they have not paid. Right?
Okay. I mean, I've worked for a big oil company that, I mean, their accounts payable,
Yeah.
they don't pay interest. The interest that accumulates on statements for unpaid bills,
Yeah.
they don't pay it.
They don't pay it.
We
Yeah,
tell
it's
the
unfortunate.
customer, we
Yeah.
tell the customer or the vendor, sorry, we won't be paying the interest. If you, phone head office if you have an issue.
Yeah. I have to say, you know, I've done, I'm not going to say a lot of work, but I've done a considerable amount of work with service-based businesses that rely on oil and gas. And even yesterday, I was thinking, why do business in that space? You've got people that hold you hostage to a price. They don't pay you. They won't pay your interest. They negotiate all the terms. They go boom and bust. They totally compromise you. It just, for me, sorry, that's my person. I'm like, wow, that's it. That's a tough business to choose getting into.
It is.
Right? It's a tough business. Now, mind you, there's definitely opportunity on the other side, but all of that needs to be weighed for sure, right? So I feel for you guys that are in that space that, you know, it's a beast. It really is. Not a fun place to be, although I know a lot of companies that, you know, they found a lot of fun once everything's going really well, but when things aren't going well, crash, right? And I remember, I remember living in Calgary, and everybody, when I first got there, it was 1999, and everyone, it was in the middle of a bust, and everyone's like, never again, I'm going to learn from my mistakes. Never again am I ever going to let this. And the bumper stickers that went out about this boom bust, and everybody repeats the cycle. It always happens, right? Like it's the behavioral piece that just kind of drives me crazy. But yeah.
It actually reminds me a little bit of farming, other than you make way more money in the oil field than you do farming.
Yeah. 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 Farming's another one, is it right? Like the risk associated, and that's, anyways, it's crazy. It's crazy. So yeah, Janelle weighs in here. You use interest as leverage. It works sometimes. Most large oil companies are really good payers. Yeah, and I think, you know, it's what I've noticed too is, and sorry, Janelle, by really good payers, I think you mean that they're willing, like they put money into it, right? They don't always pay necessarily on time. And there is money there. What's that?
They do pay, just not on time.
They do pay, yeah. And so Janelle's saying in her experience, it's been 45 to 60 days. And I have to, and I have to say in my experience too, in working with some of these companies, a lot of it has to do with the relationship that you have with different individuals within that company, right? And if someone's willing to go to bat and go run over to the accounting department and say, can you push this one forward? Sometimes there's definitely corporate policy around holding these things back, but yeah, using those leverage or relationships and building them is definitely critical, and letting people know, you know, we're vulnerable. Like this, here's what this means if this, and unfortunately there isn't a whole ton of power for you, but again, the relationships, if they're there,
because if they don't like us, they'll go somewhere else.
Yeah, they do. Yeah, for each one of you guys, there's about 15 waiting for your company, your clients, right? Just waiting in the back wings and absolutely willing to discount steeply to get the business. So, but for you, I think, you know, for you that are in the oil field services, it's really about understanding you can't compromise your business, right, to go down. If you get a certain price, you're under. So you have to find workarounds, including finding ways to diversify. You know, not being 100% reliant on oil and gas, and being able to get into some different industries, doing the same thing, but just different industries. So you've got a little bit of extra protection there.
I mean, we're bidding on a job right now that 3 other companies won't even be allowed to bid because the company we're bidding for doesn't like the other 3 because they've screwed up projects.
Wow. Yeah.
That's all it takes.
Yeah. Reputation is key. Again, there's just so many people in that space. Yeah. So true. All right. Any other, is there any uncertainty of how to do the exercise today, or does it feel pretty clear other than adding those extra rows and trying to account for deposits and final payments? No. Okay. Well, good. I'm surprised. That's good. Maybe I'll get the emails later. All right. Okay. Well, if there is nothing else, I am going to leave it there. If you are not on the call today and you're catching this video later on, you know where to find me, and please reach out if you need any clarification on mapping your sales today. This really, for the most part, tomorrow I will, and yes, thanks Janelle for sending your tab. Yeah, I'll see what's going on there. Tomorrow we are going to actually start marketing, which is about defending, finding ways to defend, I call it defend, but to justify how you're going to get these units in. And after we do that, I'm going to show you then how we start to make a few little adjustments down to our marketing expenses, because we had a benchmark here of $5,000 for your marketing mix, which we are doing tomorrow. So this will get slightly adjusted. And also today, what you can do, I mean, I'm going to show you all the things to watch for tomorrow, but you might notice based on your seasonality of when your revenues are coming in, that your team might be impacted, right? You might need to get more staff at certain times, right? Not so much your cost of goods, because that's attached to your product and service, but your employees, you might need to ramp up. You might need a little bit more infrastructure. You might need some new equipment, whatever that is, based on the sales that you've mapped out today. But I'll go through that in more detail tomorrow. All right, I'm gonna stop it there for real this time. Janelle, I'll look for your email. Otherwise, I will see everybody here tomorrow, same time, same place, and we'll actually get to some fun stuff, some marketing stuff out of all the numbers piece. All right, bye for now, everybody. See you tomorrow.